There are exceptions, but the total return backdrop slowed towards the end of September in comparison to recent memory, with emerging markets, and more specifically China, also seeing weakness. The broad volatility was more akin to a stumble than a fall, and markets have bounced over the early part of October. Year-to-date returns are still strong, and the post-pandemic recovery intact. Several factors have been at play, but the two most prominent influences have been inflation fears and the Chinese regulatory crackdown. Inflation concerns have been with us for most of 2021, yet continue to be regarded as one of the biggest tail risks. While some see inflation pressures as being driven by a rebound from depressed prices in 2020, together with temporary supply chain issues, others point to the massive fiscal and monetary stimulus, contributing to a structural increase in consumer prices. The combination of rising inflation worries and the expectation of central bank tapering translated into higher bond yields, and that influenced the returns of both stocks and bonds. For equities, a rise in bond yields could place downward pressure on stock prices, particularly those with cash flows well into the future, and that's exactly what we saw towards the end of the third quarter. But equities were not universally weak. Energy companies provided a meaningful boost to returns. Japanese shares were another rare bright spot. In fixed income markets, rising bond yields put pressure on government bond returns. This was the case both locally and globally, as broad bond indices lost money over the month of September. Despite faltering towards the end of the quarter, equities have delivered extremely strong gains over the last year and a half, with key stock markets now at or near all-time highs. At the same time, despite the recent move up in government bond rates, yields remain low in the context of history. As a result, returns are likely to be lower going forward. That means it will be more important than ever to carefully search and assess those assets with superior risk-reward prospects. The way we're investing on behalf of your clients is to be positioned for a gradual reopening post-COVID. This has meant favouring areas like energy and financials in the so-called more cyclical areas of the market. The exposure to energy was held over the course of this year, following a major review of the key global integrated energy companies and their potential cash flow path over the next 30 years, as some embark on the transition to renewables. These positions have now experienced strong returns over the last 12 months from very low levels. Going forward, we also see some dispersion existing between countries, sectors, and underlying assets. At the same time, new opportunities continue to emerge, with recent uncertainty in Chinese shares creating an opportunity for us to invest in quality Chinese businesses at a discounted price.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.